Hopefully, now that I'm back here in the US, this recording is going to work flawlessly. Fingers crossed. Welcome, everybody. This is our Stock Market Weekly update for the week of September 30th, 2019. Travis here, and I'm excited to be back home. Had a couple weeks in Asia. That was a really interesting trip, but it's good to be back home, back in US market time, so I can really track everything granularly and really get back into the swing of things. So yeah, still a lot happening in the markets right now. Today marks the end of the fiscal third quarter for probably 80 or 90% of most companies. So we're going to go ahead and get started with earnings season again in about 3 weeks. I know it felt like we just ended the last one, but that's how it goes. So yeah, we're going to get started with earnings results again for Q3 for a lot of these companies in a couple weeks. Until then, probably most of October is going to be dominated by macro headlines and political headlines. So October, tends to be a bit of a choppy month, and we're in a choppy year too. So could be an interesting month for trading. The markets were up today. They were down last week. U.S., European markets down about 1% or 2%. And this week we're starting with a positive result here today. This is actually this is the cannabis sector, which is bucking the trend. The cannabis sector continues to just kind of get crushed. But let's go over to our S&P chart here. You can see nice little pop today, up almost 1% or so. But yeah, I mean, there's a lot of political and macro news flying around out there. So who knows? Who knows where we'll end the week? But that's where we're at right now on the S&P. Still kind of hovering around that 3K level. We've just been chopping around. Some other things I'm noticing: gold and silver the last couple of days have been taking a hit. So that trade was working, but gold and silver off. I think silver was off about 5% last week. So sort of a reversal to what was going on there. I don't have a whole lot of insight into what's going to happen there over the next couple of months, but maybe someone like Nikki can chime in with some of the more technical aspects of what she's seeing on the charts. I had noticed that gold and silver were kind of trading inversely to the equities markets, so we'll see if that, if the equity markets reverse, if gold and silver will get some mojo back. But interesting enough, with crypto down, it's almost as if gold and silver have been acting more like crypto. So that's something to keep an eye on. But in any case, there's a lot of macro stuff flying around. Last week, we only had a couple of macro data points. There was personal income and spending in the U.S. Everything macro data on the macro data front looks pretty mixed, right? Like I've talked about last week how we got a really weak reading in the manufacturing sector in Germany. The UK actually came out with their GDP numbers today. And let's see if we can show that. I'm going to open up another tab here in Koyfin. But yeah, you can see if we go over to this economic calendar, GDP growth rate for the UK was actually negative for this quarter. So, the UK obviously has some of their own issues there with the Brexit uncertainty. And that certainly is weighing on some of the economic results there, and just some general economic weakness across Europe as a whole. But yeah, so especially on the manufacturing front, we've seen some really weak numbers. On the opposite side, we've seen still pretty stable employment metrics. We've seen service sectors tends to still look okay. Like job losses don't seem to be accelerating as far as we can tell here in the U.S. We've still got the trade war stuff on, but yeah, it's just a lot of mixed results. Let me just show you, last week, actually I have this calendar up. You'll see the major things we had were, on Friday, we had the durable goods orders and the personal income and spending. So, the personal income side looked fine. It was in line with consensus, but the personal spending was a little bit weaker than expected. And, but the durable goods orders looked fine. So it's some things look okay, some things look not so great. We had two different consumer sentiment surveys, like the Michigan Consumer Sentiment Survey actually was a little bit better than expected, but there was another consumer sentiment survey where it was a little worse than expected. And I don't know if that's showing up on here, but in any case, we're just seeing a lot of like choppiness and mixed results in a lot of the data that we're seeing on the manufacturing side. We are seeing pretty weak results just globally. So a lot of people are referring to this as like a manufacturing recession right now. But a lot of that's probably also driven by uncertainty with trade. You've got things like, actually, I think a really good example of this. So Thor Industries is a company that I've kind of been watching. They make RVs and like travel trailers and those kinds of products. And so they actually took on a bunch of debt to buy the largest manufacturer of RVs and manufactured homes in Europe recently. But they're a pretty good read on what's happening kind of globally, because I was looking through their results from the most recent quarter they reported today, their fourth quarter. And it's interesting because, let me see if I can find the numbers here again. What's happening is there's a lot of uncertainty. They sell a lot of their products to dealers, who then the dealers go and then sell those products to consumers. So there's kind of like the dealers act as kind of a middleman. And the dealers have been buying less and less RVs and trailers because they're sort of destocking inventory. They're worried that we're about to roll into a recession. And so when you look at the dealer numbers, they're down about 20% year over year. So let's find this slide. You can see all their brands here. They own a lot of brands. This is probably the largest, I think, in the world now in terms of RVs manufacturer. They have a bunch of different brands, a bunch of different types. You can see here like camper vans, caravans, motor caravans. But here we go. Okay, so year to date through June, you've got industry retail registrations. So these are like the numbers like for the end consumer, down about 9% year over year in North America. And the wholesale shipments to dealers are down about 20%. So what that means is dealers are buying far less units than the actual industry is performing. The industry is not doing great. It's down. Consumers are buying 9% this year than they did 9% less units this year than they did last year. But dealers in turn have bought 20% less. So the dealers are destocking their inventories, and the reason is because they're worried about what growth is going to look like going forward. And if we're tipping in a recession, the dealers don't want to get stuck with a bunch of excess inventory that they're going to have to sell at fire sale prices, which they might, end up losing money on if they have to cut too deeply. So that's kind of what's happening in some of the industries like this. That's what's happening with Mastercraft, which I talked about last week. They still see pretty good end consumer demand for their boats, but they see dealers actually taking on far fewer orders than they otherwise would relative to the end user sales, because the dealers are freaking out that we're headed into recession. So it's a bit of a confidence problem, and this confidence problem actually can turn into, that's actually how recessions get started, is when you have this like mass confidence problem among lots of different businesses, then it starts to feed on itself and it becomes a feedback loop, a self-reinforcing feedback loop that leads to a recession. So if enough, industries start to get too cautious, maybe even they start to cut some jobs, that hurts income, then consumers stop spending, and then it just feeds on itself, right? And so that's how you get a recession. So we're seeing signs of it in like areas like RVs and like high dollar purchases like that. Automobile sector, kind of similar, has been a bit weak this year. Dealers are kind of skittish, but overall the employment data is still pretty decent. So we're not seeing like massive job losses yet. If we start to see that, that's I think when we'll get pretty concerned, and then we'll know we're in like more of a broad recessionary type of environment, as opposed to just like maybe a manufacturing sector slowdown. So that's kind of what I'm watching and waiting to see. One of the forward indicators I always look at, we get these initial jobless claims numbers every week. So it has ticked up the last couple of weeks, but this level as a whole, this 213,000 jobless claims number on a weekly basis, is still pretty low. So when that ticks above like 240, 250 is when I would start to say, like maybe we've got a problem. And it would have to do that for like more than a week or two. Since these are weekly numbers, they can be a little bit volatile. But like if you let's look at a 5-year basis, you can see that it's trended down over time. So if we got a spike back above 250, that's when I might be a little concerned. But until that happens, I'm not too worried about the state of the consumer. So that's kind of how I'm looking at things from a macro perspective. We'll continue to just gather more data and see what happens. And this week we get a few macro data points. We get manufacturing data in the U.S. on Tuesday, and we get non-farm payroll, which is jobs data for the month of September, on Friday. Let me just go ahead and pull that up for you guys. Let's see. We'll move it to this week. Yeah, so you can always see, like, the ones in red are always the more important ones. So you can see the manufacturing data that comes out tomorrow. Non-manufacturing data comes out on Thursday. And then on Friday, we have the non-farm payroll reports and the balance of trade, which is imports and exports. So this one, really, the non-farm payrolls is probably going to be the big one. That and the ISM non-manufacturing on Thursday. Because we already know manufacturing is pretty weak, but we want to see this hold up, and we want to see this jobs data still look pretty good. So that's what people will be watching, at least for U.S. data. There's not a whole lot of macro data outside the U.S. If we go to COIFIN, you can see that too. Like, here's the calendar. Pretty much U.S. dominated this week. So yeah, so that's pretty much it on that front. There are a couple companies that report earnings. We get Stitch Fix tomorrow. That's the stock that I've been watching. Let's go ahead and pull up a chart here because it's been an interesting, volatile stock over the last year or so. So you can see this stock has been as low as like $16 in the last year. It's been as high as mid 30s. So yeah, it's been a pretty choppy stock. It's actually probably been a pretty good one to trade. It's a battleground stock. A lot of people think that this business model is, subject to too much competition and too much customer churn. Other people think that, that they've got a great CEO, they've got a data advantage, they've got a unique product in the retail space that can't be easily replicated. They've got opportunities to grow in like the kids and the men's businesses and internationally. So it's a really interesting battleground stock. I really like the management team here. I think that I've been waiting for it to really come into a more compelling valuation. So it's not an expensive stock, but it's also not like a cheap stock yet. And I think it would be interesting to pick this up at a time of like pretty deep pessimism. So I'm going to be watching their results on Tuesday. And then on Wednesday, we get Lennar, which is the largest home builder in the U.S. We get Ford, I believe, which is, Ford Motor, the big auto manufacturer. Paychex, which is a payroll processor and HR company. Pretty big read. They should have a pretty interesting view on the U.S. economy generally. So that may be an interesting earnings report on Wednesday to take a look at, just for the sake of trying to understand what the employment market looks like in the U.S. and if it's stable. And then Bed Bath & Beyond, which is another battleground stock in the retail sector. It's one that I've been watching, and it's pretty deeply discounted on like an enterprise value to sales basis, or any other valuation metric you want to look at. It has had a rally off this bottom here, so it'll be interesting to see what happens with results on Wednesday. I don't expect the results to be gangbusters, but will be interesting to see how the stock trades off of that. So that's another one on Wednesday. And then on Thursday, we get PepsiCo, Constellation Brands, which owns a large stake in Canopy Growth, which is a big cannabis company that we've talked about in the past. And so Constellation owns a large portfolio of liquor, beer, and wine brands. And they also own this big stake in Canopy. So Constellation trades under this ticker STZ. And it's actually been a pretty good performer. I mean, let's look at a 5-year chart. You can see that it's been more than a double in the past 5 years. Generally, the performance of the brands has been pretty good, and it's a company that seems to execute pretty well. It trades for, I think, let's look at the valuation. It's not like a super cheap stock, so it's never been one that I've been, too interested in. It's not like super expensive, but it trades for like, I think 20 or 25 times forward estimates of earnings. Let's go ahead and look. Yeah. So analysts estimating about $9 to $9.50 in earnings over the next year. And, you're 207. So you're trading about 23 times earnings, which isn't super expensive for a company that's continually growing. But it is above a market average multiple. So, you can see if we go to like the financials here, their revenue growth rate hasn't been like super robust in the last couple of quarters, growing low single digit percentages. I think they divested some brands though, and that's why like the growth rate doesn't look better. I think when you look at the performance of their brands, it more so matches the revenue growth of what we saw in previous quarters of high single digits. So, and we can confirm that if like we go to their investor relations site. I know they put out some really good. Sorry, that's a different company. STZ. They have some really good presentations that they put out for the earnings calls and things like that. So let's see if we can find it. Go to the events and presentations section. Yeah, and they'll do conference presentations too, where they have presentations as well. We can pull up. But anyway, STZ reports on Thursday, and that'll be an interesting read on CGC as well. It'd be interesting to hear what they say about about their stake in Canopy and how they're feeling about that. So yeah, you can see here they have a pretty nice shareholder presentation where they talk about their brands, lots of different data on the category and the percentage growth rates and things like that. So it's a really good investor presentation. And they talk about their growth rates and their share in the industry and things like that. So yeah, they talk about lots of different segments of their markets. So yeah, they own some of these brands, and they own a bunch of different stuff. But good company. Not one that I'm currently invested in, but yeah. And then they talk about their Canopy growth investment. I think they invested too much capital into Canopy. They actually have an additional, I think, $5 billion that could end up getting invested in Canopy as well. They've already invested, I think, 4 or 5, and they've got another, I want to say 4 or 5 that may follow on. But Canopy's, I don't think, performing as well as they want it to yet. So that's interesting. But they report on Thursday. So we get PepsiCo, Constellation Brands on Thursday. Costco reports on Thursday. That's another one that will be widely watched. Costco results have been pretty good the last couple quarters, so I imagine they'll keep performing well. No reason to believe they won't. They just opened some of their first stores in China, and by all accounts, the Costco openings there were like super gangbusters. Like people were just lined up in front of the store for like a day ahead of time. And when they, there were like these news reports that showed videos of people just like trampling each other, trying to get into Costco China on the first day. So that was interesting. Costco's got a pretty big opportunity there, it seems, in China. And that's really it on the earnings front. So not a lot of companies, but definitely a few that I think are interesting and worth watching. That's pretty much it on, the stuff for this upcoming week. Last week earnings, I showed you Thor. They actually reported today. The stock was up because the forward guidance suggested that things weren't getting like incrementally worse than people expected. So like even though results weren't great, you can see here this. Let's look at it. Yeah, you can see here there was a gap up on earnings. Now this stock had been hammered. It's down about, I want to say it was down about 50% over the last 6 months or last year or so. So it's not that surprising that we saw it get a little pop here. The valuation on it, I think it trades for like a single digit multiple of forward earnings. But again, if we go into pretty deep recession earnings, they might actually have net losses. Because this business has a lot of fixed costs with manufacturing those RVs. So that's the reason that, this stock has been pretty weak over the past year. But yeah, I'm going to keep an eye on it. It's not one I'm ready to get involved with just yet. But it was interesting. One of my one of the hedge funds I track that I respect a lot actually bought some here in the low 40s. So that was interesting to see. Let's see where earnings estimates are for Thor. Consensus estimates for next year looks like about $5.50 or so. I'm actually surprised at this. So it looks like the earnings estimates are higher for next year than this current year. So the earnings estimates, as you can see, have been coming down over time. You know, the analysts had a year ago expected this company to earn as much as like $8 or $10 a share in the next year or two, and now, you know, expecting more like $5 or $6 over the next year or two. So, you know, in the low 40s, you were talking about, you know, call it, you know, 7 or 8 times earnings, price to earnings multiple. Now I think today at today's price, it's what, 50, 56 or so. So it's a little bit more expensive. It's, you know, more like low double digit earnings, price to earnings multiple. So I think there's a lot of other stocks out there that are reflecting high probability of recession that are still trading at single digit earnings multiples. So, and I think they have a little bit better characteristics than Thor. So I think at today's prices, that's why, you know, I think there are more interesting things outside of a company like Thor. But it is definitely one I'm going to keep an eye on because I think it can be one that goes back down to annual lows pretty quickly. And at some price, I get interested. So it's definitely one I'm going to keep an eye on. Micron was the other one that reported. They reported last Thursday, I believe, and or maybe it was Friday morning, but that stock was down about 10%. So Micron's been an interesting one. This is a really interesting case study in the market, and why it's pretty difficult to outperform in the stock market. So Micron, as you all know, if you followed me and followed the Skill Incubator watch list, this has been on our watch list since the beginning. And this was a stock that I followed for the last couple of years. It's a really interesting business. They are part of a duopoly in DRAM and part of a kind of an oligopoly in NAND. So they provide non-volatile flash memory and memory for pretty much every use case you can think of, right? Like they sell to like the Apples and Qualcomms of the world and all the chip makers. And they had a joint venture with Intel, et cetera, et cetera. So this stock used to be, let's look at a 5-year chart because I think it's interesting. This was, Micron used to be like this industry kind of transformed. Micron bought like it's one of its largest competitors out of bankruptcy in the DRAM space back here in the like mid 2015, 2016 timeframe. And that's why the stock went from like $10 to like almost $60 at one point within like 2 years. So the earnings profile of this company changed dramatically. They were buying back stock at cheap prices, paying down debt, doing all the right things. The industry was getting a tailwind. DRAM prices went parabolic, and they were enjoying the highest profits they'd ever seen. And analysts were expecting that this company could earn between $10 and $20 a share. And so even at $60 a share, people thought that it was a cheap stock if they could earn $10 a share. It was still only trading at like 6 times earnings. And obviously this is a cyclical industry, but the DRAM prices came back in, obviously the trade war stuff and the like Huawei stuff and all that, and the weakening of some of the semiconductor markets hit Micron. So Micron stock went from $60 down to about $30. And, you know, this is a stock that I think can be $100 stock in, call it, 2 years time frame when they get back to earning, 10 or $15 a share. But right now, the stock has been weak, and it's unclear when that recovery in DRAM and NAND prices is going to happen. And there's some question as to, if we go into a recession, can Micron even maintain positive earnings? So that's why I thought this stock could actually dip into like the $20 range if things got bad enough from a competitive standpoint. But it really didn't quite get there. And instead, this stock rallied from $30 to $50 in a couple of months time frame. Like if we look at a 6-month chart, you can see bottomed out right in the low 30s in the June time frame. And since then, there was like a small upturn in DRAM prices, and that sent the stock up from $30 to $50. So pretty huge increase there, almost a double in the stock price just from a very small recovery in DRAM prices. Now, their earnings results, they actually were down about 10%. So the stock is trading low 40s again. And if we look at the financial results of Micron, they continue to get worse. So even though there's been a small uptick in DRAM prices on the spot market, Micron's results continue to deteriorate. So if we look at the quarterly results, look at the growth rate, for instance, revenue growth is the worst it's been all year. So they were seeing a 42% decline in revenue. That has, they were growing in 2018 at like, 30, 40, 50%. And that decelerated very quickly and turned negative 20 in this 2 quarters ago. And now they're at negative 40% revenue growth. So pretty big deterioration. You can see net income deteriorated even faster. They were earning $3-4 billion a quarter, and now they're only earning about $500 million a quarter. So earnings got slashed by like 75-80%. So that is why, I'm still not sure that we've seen the final bottom in the stock. But analysts were anticipating that the cycle for all of these memory guys was going to turn, and that Micron was going to be back in like 6 or 12 months to earning, a couple $2 billion a quarter. And so I just want to take a look at the earnings estimates here because I think this is really interesting. So if we look at, let's actually go to a graph. Let's see. I'm going to pull up the fiscal year earnings estimate. Let's see. Yeah, so here we go. So this is Micron's fiscal year 2020, which is basically like, I think they report on a mid-year calendar. So I think it's like June to June or something is their fiscal year. But you can see that they, at one point, let's look at a 1-year chart of this earnings estimate. So again, analysts were estimating that Micron was going to earn like $10 a share this year, like back in 2018. And I think in the spring, when I put this on our watch list, I think I said, I think things are going to get worse than analysts expect. This was back here when analysts were like, no, they're still going to earn like $7 or $8 a share. I said, no, I think actually it's going to be more like $4 or $5 a share. I was actually even more optimistic than I should have been, because now the earnings estimates for this fiscal year for Micron are like $2.50 a share. So the earnings estimates have actually gotten even worse than I expected. Much worse than analysts were expecting, even back in like the spring timeframe. I mean, this is 2019, right? Back in the spring, back in February, March, analysts still expected like $6-7 of earnings. And I was saying, again, I think I was saying $4 or $5 is more what I expected. And now we're talking about a $2.50 earnings estimate. So these estimates have just stair-stepped down continually. And even after their last earnings result, they're cut further again. And yet this is what the stock price looks like since then, right? So, and actually, let's go to a year-to-date chart for Micron. You can see that, back in the early spring timeframe, it was trading like around $40 a share. It finally sold off in June, well, I guess late May, June timeframe. Finally sold off. That's where we got that sell-off from about $40 to $30 on that second or third cut in earnings results. But then the stock price has rallied. It's rallied from $30 to $50, despite the fact that earnings estimates for this year continue to decline. So this is what makes investing in stocks so difficult sometimes, because the stock price is always a forward-looking indicator, right? It's the stock price reflects like expectations about the future. So what's happening here is Micron stock is still reflecting optimism that things are going to turn around in the next 6-12 months, and that earnings estimates for the following year are going to actually eventually improve, right? So fiscal year 2021, we can see that there is this small... Can you guys hear me? I think... Type yes in the chat if you can hear me. In and out. Okay. All right. Hopefully you can hear me now. All right. So we've got this fiscal year 2021 estimate, which is next year's earnings estimate. You can see that it's come down from $9 or $10 a share, and now it's at about 550. But there's been a slight uptick just in the past 2 months or so. So that's what's driving the stock price increase here, is just a small inflection, small improvement in the earnings estimate for the following fiscal year. Man, this mic is going bananas. I don't know if my system is correctly recognizing it, but hopefully it's all good. So yeah, so that's what's happening. I don't think the stock price deserved to really go from 30 to 50, and that may be why it gapped down after earnings here, when analysts realized maybe it's not recovering as fast as they expected it to. So I'm still going to be patient on Micron. I think there's still some indications that the market's really not recovering as fast as some people expect it to. So you can see here when you look at the DXI, which is it's a company called TrendForce puts together a index of memory prices, and this is spot market. So Micron prices a lot of its contracts not on the spot market, but in like direct negotiations with its customers. So it's not always a direct indication of Micron's, forward-looking revenue growth rates or pricing, but it's, somewhat correlated. So you can see that this from basically early this year to middle of this year, prices of memory were just straight down. There was a bounce, but it's since sold off. Since the beginning of August, we've had about 2 months of memory prices selling off again. Maybe there's a flattening out here, but you can see that prices did have a recovery, but then have started to trail off a bit again. So I'm not convinced that we've had the bottom in the semi cycle and in the memory price cycle, but again, I think I'd like to be able to accumulate this stock in the 30s or 20s for a longer term play, because again, I think when they do eventually turn back up, they can earn $10 a share in earnings, and you put even just a small multiple of earnings, like an 8 or 10x multiple, which is below a market multiple, to account for the cyclicality of the industry. Even that, even a 9 times or 10 times multiple on a $10 earnings figure gets you to about $100 share price. So I think from a risk reward standpoint too, like if you can buy this in the 30s and you get a 3x type of upside in a recovery scenario, that's a pretty good setup. So we'll continue to be patient. I'll continue to be patient on this one, and just kind of monitor things, but I would love to see this thing correct a little bit more. So, and again, the earnings estimates for 2021 are still only like $5.50 a share. For 2022, there's probably not that many estimates out there, but whatever ones are out there currently are estimating about $7.50 earnings. So that's Micron right now. And that's pretty much it. The other major thing related to our watch list this week was there was the news or the rumors that some of these Chinese stocks that are listed, obviously you guys know that Baidu is my largest position. We've also got a couple other names. I own a little bit of JD. We've talked about Tencent. These are Chinese stocks that I think are interesting that are on our watch list. Ctrip as well. That one's come in a lot. But there were these rumors that the Chinese stocks were going to be subject to potential delisting as part of the trade war. So this was a rumor. The Treasury Department actually came out and said they're not considering this. But on Friday, this sent a lot of the Chinese stocks down 4, 5, 6%. And it is a real concern. So basically what was being rumored, there's a couple different things that were being rumored, but as part of this, trade war, tit for tat, Another potential weapon in the trade war toolkit that the Trump administration may be considering is looking to restrict the ability of U.S. investors to invest in Chinese companies. And there's a variety of different things they can do there. They could decide that, no more Chinese IPO or no more Chinese companies can IPO in U.S. markets, but maybe the existing ones can continue to trade. That would be one way to do it. They could say, they could actually potentially, and this was what investors are worried about, delist these already existing companies that trade in the U.S. markets. I think that would be an extreme measure, and that is probably a very, very low probability of happening. And that's because it really doesn't hurt the Chinese. It just hurts U.S. investors. So these Chinese companies have already raised capital from U.S. investors. So by delisting these companies, and delisting, it's not clear what exactly would happen, but let's assume that the worst case scenario, they delist these companies and somehow like your existing shareholders just get like wiped out. Then that hurts U.S. investors more than the Chinese companies, because the Chinese companies have already raised this capital. They already have the cash from selling shares in the U.S. market. So they could just go relist in Hong Kong or Shanghai and it's fine. But the U.S. investors would be the ones that got hurt. And that includes like large ETFs, like one of the largest Chinese ETFs. What is it? I think the MSCI Emerging Markets ETF, which has a couple $100 billion of assets, I want to say, or maybe it's let's go ahead and look. But about 30% of their assets are in these U.S. listed Chinese stocks. So you can see China has a 33% weight. This is the EEM, and the EEM has, let's see if we can find it. Well, let's just do EEM ETF. Yeah, it's the iShares MSCI Emerging Markets ETF. I believe it's the largest, and there are others too that are similar emerging market ETFs that also run a bunch of tens of billions of assets and are also heavily invested. So this ETF has an AUM, let's see if we can find it. 25 billion of assets in this ETF alone. And about 33% of this ETF, I mean, their top holding is Alibaba, second top holding Tencent, and they own a bunch of Chinese stocks, China Construction, Ping An. Some of these they own the Hong Kong version, but a lot of these, like Baba, this is the U.S. traded version of the company. So they own. I don't even know if it'll allow us to drill down into the specific holdings. But anyway, they own a bunch of these U.S. Listed Chinese companies, as do a bunch of multi-billion-dollar hedge funds, as do a bunch of retail investors. So it really would only hurt U.S. investors to have like a dramatic outcome where these things get delisted. The other thing is that it's possible that U.S. investors would still own their holdings if these companies, Chinese companies, got delisted. The U.S. investors hopefully would still have a claim to their shares, and then these companies could relist in Hong Kong or Singapore or Shanghai. Probably Hong Kong or Shanghai. Hong Kong or Singapore for the U.S. investors to maintain their ownership stake. So we don't know, even in one of these bad scenarios where these Chinese companies get delisted from U.S. exchanges, we don't know if that actually means a loss of ownership or not. And again, I think that's a pretty far off probability. I think that's a pretty low probability of actually happening anyway. But these rumors sent these stocks down on Friday. And I do think the Trump administration probably floated that rumor to the press to give them some more ammunition in the upcoming negotiations, which are going to happen this month. So I think it's probably one of those things where it's posturing. It's like not an actual likely thing to happen, but it is a potential, weapon for trade negotiations, and that's why it's being floated out there. So I'm not too concerned, but it is something I'm going to keep a really close eye on because, I do find some of these Chinese stocks pretty interesting, and I want to stay invested in them. So that's kind of how I'm looking at the situation now. Could be a good buying opportunity on some of these. Ctrip continues to come in. This is one that I'm getting quite interested in at these levels. And JD as well, I think, had a nice pullback. JD's results have been really good in the past couple of quarters. Their most recent quarterly results looked really good. The stock has rallied somewhat, or it had rallied above $30 a share. This was a $20 or $22 stock, I think, at the beginning of the year. And had a nice 50% rally and was above $30. I thought it was about to continue its upward trend, but then we got this correction. So this might be a little buying opportunity here in JD as well. And then, of course, Baidu, which I think continues to be just dramatically undervalued, hasn't really had a good recovery yet. And I was buying here in the low 100s and even bought a little bit sub 100. I think my average cost on Baidu is still upwards of like 105, 110, maybe even a little higher. But in any case, I think it's dramatically undervalued at these levels, and I want to be able to hold this for a couple of years. So, I hope that the worst case scenario doesn't play out here. But you never know. And that's why you position size it. Even though Baidu is my largest position, it's only like, I think, an 8% position size. And that's why you don't invest your entire portfolio in one stock. So there's always risk. But yeah, that's pretty much all I have for now. One other thing that I had mentioned earlier was cannabis. I'm going to start hunting for some potential value in this sector because a lot of these stocks are down 50 to 60% year to date now. I thought at the beginning of the year, they were probably pricing in too much optimism about, the sector, because not all these companies can be winners, even though it's a big industry that's going to grow a lot in the next 10 years. Not every one of these companies is going to be a multi-billion-dollar company. So you can see that a lot of these companies are now off 50% or more for the year now. So these valuations have gotten a lot more reasonable. I don't know that they're totally reasonable yet, but definitely a place where I think it's time to maybe start poking around to see if there's some interesting and valuable long-term plays here in the cannabis sector. So I'll probably spend some time looking at these companies again. So we'll just get to your questions now. So scrolling through, OCY asked earlier on the macro front, isn't unemployment and jobs a lagging indicator? Yeah, generally, unemployment and jobs is a bit of a lagging indicator because, companies typically will start to cut jobs after they see things rolling over, but that's not always the case. That's why I like to look at the weekly jobs numbers, because that's probably more of a real-time indicator of are there sectors starting to trim off jobs because they're seeing, like I showed you with Thor and some of those other companies, like are they seeing, from their perspective, a rolling over of, purchases and spending and purchases by their customers and things like that. So it's not, on the weekly employment stuff, it can be a little bit more real time than some of the monthly jobs numbers or something like GDP, which is probably an extreme lagging indicator, right? So, there's a couple different other leading indicators too that I like to look at. So, but you're right that generally employment tends to be more of a lagging indicator than not. And it's really hard to find like a very far ahead leading indicator. Like there just really doesn't exist a ton of like far out leading indicators of recession, because recession typically happens really quickly and in conjunction like with a lot of things at one time. So yeah, people talk about like yield curve inversions and stock markets being like the most leading indicators. And certainly that's probably true. But it's hard to find other leading indicators that are like more than 2 or 3 months out. So, sometimes I like to, you can look for things like business investment. You can look at things like, large ticket purchases like auto sales. You can look at things like credit card delinquency trends. So some of those things can sometimes be leading indicators. So I always look at that kind of stuff anywhere it's possible to see it. But yeah, good point. And then, there's another question about sell target for Urban. Yeah, so Urban's been doing pretty well. This is a retail stock that I bought a little bit back in the low 20s, I think. And it had a nice day today, up 7%. I didn't see any news on it. I'm going to have to take a look, but it's rallied along with some of the retail names. Retail was just so beaten up, and I think finally there was this rotation out of some of the more expensive tech stuff into more value names, and that included the retail space. So we've seen a rally in some retail names. I showed you Bed Bath & Beyond earlier. Certainly Urban, rallying from 20 to 28 here, which is almost 50% in a couple of in like a month and a half. So yeah, no real catalyst. That's the thing with a lot of these things when they get so beaten up. Sometimes it doesn't take an actual news catalyst. It just, a stock gets too cheap, and then other people start noticing and buying, and then all of a sudden you look back and you're up 30, 40, 50% in a month. So I like to have catalysts for a stock, but sometimes they just get too cheap to ignore, and you don't need to worry about catalysts because the stock price will take care of itself. So Urban might be a little bit ahead of itself here, but nice to see some recovery. I'm probably going to take some profit here between like 28 and 30, and then I would look to probably sell the rest at about a somewhere between 50 and 100% gain. So first profit target right around $29-30. Second target would be more like $40 probably. So, or close to that, depending on how fundamentals develop too in the meantime. So that's kind of how I'm thinking about it. Yeah, let's just go ahead and check on it. I need to check that there wasn't any news today. I didn't see anything earlier, but they might have gotten an analyst upgrade. Yeah, so yeah, they did get an analyst upgrade from Wells Fargo. So Wells Fargo says, we believe positive comps and flat gross margins are possible for fourth quarter. And, there's really not any real news here. It's just an analyst saying they think that results may not be as bad as people expect, and they raise their price target on the company from $25 to $30. Okay, thanks, Wells Fargo. And that, by the way, let's look at what that represents in terms of valuation. Analysts collectively estimate $2.30 of earnings this year. Next year, about $2.50. So, their previous price target was 25, which would have been about 10 times next year's earnings. And then even at $30, that's about 12 times next year's earnings. So still a very, very cheap, reasonable target based on current earnings estimates. And yeah, at the $40 target that I mentioned, where it would be like kind of my second profit target, that is about 16 times next year's earnings, which is right in line with the market's average. So essentially what that means is, I think that once Urban gets to a kind of market average price to earnings multiple, that's where I think it's probably pretty fairly valued. Because I don't think there's a ton of growth expected for this company over the next problems again. Yeah, I don't think there's a ton of growth that should be baked into this company over the next couple of years, but I do think they allocate capital well. They have a strong balance sheet. They have some low single digit track record of growth over the last couple of years. So yeah, I think it deserves about a market average multiple. I mean, yeah, if we look at the financials here, they've actually grown earnings pretty nicely over the past couple of years. So let's see if we can pull that up. Pull up, yeah, I think EPS, earnings per share, because they have bought back stock. So I think earnings per share last 12 months. Let's look at the last 3 years. Yeah, so it's been a bit of a mixed picture. Earnings had declined a little bit. Yeah, it looks like maybe there was a one-time charge that might have created a short-term dip in earnings, but overall you can see that there's been they were earning low dollar per share back in 2010, and then today they're earning above $2 a share. So there's been general growth in their earnings over time. You can see, if we look on Let's look at operating income. You can see they've grown it on an annual basis. If we look at operating income, yeah, I mean, it hasn't grown a lot, but net income, yeah, it's grown a bit. It's choppy though. But yeah, you can see their shares, they've bought back shares consistently. So their share count has gone from even just 4 years ago, 136 million shares. Now we're talking about, they're probably closer to 100, 105 million shares as of this past quarter. So that's always nice to see. Yeah. Pretty good little dip buy here, huh? What was our average cost on that? What was my average cost? I think it was 22-ish, 23 maybe. Yeah. What other questions, y'all? Anything else out there? I don't know. I don't know if Nikki's still, I believe she's still in her swing trade on Domo. I hadn't heard any change in her. Let's try a different interval here. Yeah, I think it has come in a bit. Yeah, but I don't think she's really changed anything. Now I'm forgetting what my average cost is on Urban, but I'll have to go back and see. Either open up my brokerage account or just go back to our trade alerts. Yeah, I think. Yeah, I know it was low 20s. In any case, yeah, I think retail's been got a nice recovery. Let's look at our retail list. This is a bunch of retail stocks that I follow. Foot Locker's had a nice rally too. It's been a nice one. I thought that one got way too cheap. Bought that one at about 40, high 30s, low 40s. And then, of course, we've had a bit of recovery in Nordstrom, but still not quite there yet. Dick's, actually, this was a stock that I thought got really cheap too. I didn't buy any, but it was trading for, I think, like 9 times earnings after their last earnings report, and it looked their last earnings report looked solid. I was surprised. It had traded down to like low 30s, and at that level was trading for like 10 times earnings down here back in late summer, and since then is up up about 30 to 35% from there. Kind of missed that one, but you can't be in everything. Interestingly, though, Macerich, which I still really, really like at these prices, has not had the rally that some of the other retailers have had. It got a little bit of a pop off of that spike that we saw in value stocks, but really since then has trailed off again. So yeah, I'm not really concerned about that actually, but I just thought it was interesting that some of these other retail stocks have been rallying while Macerich hasn't really rallied as much. Cool. Well, that's pretty much it from me. I think that about wraps it up, unless you guys have any other questions. Awesome, y'all. Well, y'all have a great rest of your afternoon, evening, and I'll be in the channel. I'm back locked and loaded, engaged in markets again. So look out for new content from me this week, y'all. Have a good one. Take care.